Welcome back. This is episode 4 of a special series where Johannes van Morel and I go chapter by chapter through his new book, Introduction to Supply Chain. We go back and forth, we debate the merits of the ideas, particularly from the perspective of someone who might be a first-time reader, who's never heard of Lokad, has received what you might call the mainstream approach to training, and they might have certain questions about the content. That's the position I take in this series. If you haven't seen the first 3 episodes, I strongly recommend that you watch them because, as you can imagine, this is an ongoing series, an ongoing discussion, and from time to time we do make callbacks to things that were discussed previously. And with that, Johannes, thank you for joining me. Episode 4. We will be discussing Chapter 4, titled The Empire Strikes... Economics. Economics. So, Johannes, what is the grand central thesis of the chapter called Economics?
It's about answering a very, very simple question. What are we even trying to do? And then the consequence of that. So what are we even trying to do? Making money. Okay, that's the whole point.
You're very explicit about that.
You're
Unapologetically capitalistic
we are in business.
About that. Yep, exactly.
We are going to make money. And by the way, it has consequences. We are just making money. That's it. So it is not that we need to do money. Is that, in fact, this is just what we should actually do. And that's also the part, because people can get confused. They say, oh yes, we need to make money and plenty of other things. And I say, up.
Yeah.
We need to make money, period. And this is important. This is important because when people think, oh, but if you're just making money, period, you're such a villain, you're such a bad person, etc., etc. And here, it reflects this response reflect that people don't understand what making money actually means. And thus, if they don't understand what actually making money means and why, when you say that, then all sort of bizarre consequences, bizarre misunderstanding unfold from that, and we drift into, I would say, irrelevant questions. So fundamentally, this is very important. And this chapter, Economics, follows epistemology where we have tried to eliminate, I would say, the categorical thinking errors when we were approaching supply chains. So here, again, we have eliminated that we should not think of supply chain as math. This is as solving math puzzles. This is nowadays. And we should not think of supply chain as a management thing where we are just slicing and dicing the division of labor. This is just, again, slicing and dicing division of labor is a very secondary concern. It is... Again, it is the primary concern is making money, and that's the point of economics, is that to understand how this concern, we want to make money, how does it relate to supply chain, and in the grand scheme of things, if we are looking at supply chain in the grand tree of human knowledge, where do we place supply chain in this grand tree? That's essentially the answer that this chapter provides.
Well, I have prepared questions, but you've already said things I want to follow up on. Again, because I know in the chapter you do make the point that you don't want people to confuse supply chain with some sort of moral pursuit.
Yes.
That's again your own terminology.
Yes.
You talk about it. There's no moral dimension to what we're doing here. We're making money, but you just made the claim that most people don't actually know what making money actually means.
Yes.
So, from the perspective of the book, which is again Introduction to Supply Chain. What do you mean by, like, how do the 10 million average practitioners not really understand what making money actually means?
So first, I am putting myself philosophically in. So what is my philosophical statement? I'm saying this is a game, playing money, that I will play without coercion. That's it. So I cannot, nobody can actually physically force anybody to do anything. That's the only thing that I'm saying. Just that. Nobody can force people to do anything. In the real life, this is not true. In the real life, if the French police wants to take me away and throw me in jail for good reasons or bad reasons, they definitively can. So use of force in the real life is a real thing. It is a real thing. You can get what you want by force. Governments do that all the time.
Yeah, with there are regulations that you have
exactly.
to adhere to.
I'm not saying, again, it is not... So force exists. And this is a dimension that is essential to the human existence.
Yes.
But what I'm saying for supply chain, for the context, we are as a paradigm, we are operating in a paradigm of voluntary cooperation. And I'm making that clear that we are not. That's why I say supply chain for armies and armed forces do not abide to the same code.
Yes.
They do not, because the use of force is on the table.
Yes.
So here I'm just saying, okay, if we start from the point that we are playing a game that is fundamentally cooperative, I cannot force anybody to do anything. My employees, if they don't want, they will leave. My clients, if they don't want, they will leave. If my suppliers don't like me because I'm such a pain, they will leave. So you see, nobody can be forced. And when you say, oh, money can force people, no. Money cannot force. You have, by the way, an expression, having fuck you money.
Yes.
When you have enough money that nobody can force you to do anything. So you see, it's just as a philosophical.
We may have to
stance,
blur that on YouTube, but yes.
it's as a philosophical stance. I'm just saying that the game of supply chain is played from a non-aggressive perspective. That's it.
Okay.
So that's the rule of the game. Now it's very little. The only thing that I'm saying is just that for people playing supply chain, you're not allowed to use force and guns. That's what I'm saying. I think for everybody it's self-evident. But it is. I just want to point out that it is a very, very limited assumption.
Okay.
I'm not making a grand assumption. I just say you cannot force with a gun to have someone buy your product and pay you. That's it. Okay. So it's not. It's a very basic expectation, and I think nobody is even thinking the opposite. Now
let's bring it back to
yes, exactly. Back to the initial case.
Yes.
When people say making money is a bad thing, is that this statement contradicts they assume that the bad consequences will unfold, but that contradicts what I just said, which is you can't force anybody to do anything. Thus, for example, when people say, oh, if we let a CEO, do their own things, this CEO, he will do such a disservice to society. He will abuse customers. He will do the bad thing this and bad thing that, etc., etc. How is it exactly going to work out? If the CEO of a very large corporation start to act in ways that are morally reprehensible, even if it's legal against his own customers, the customers are going to leave. You see, they are going definitively to leave. If the top management of Apple lose their mind and the next iPhone is a piece of crap, people will leave. They cannot force. Maybe people are in love with Apple, and they will be so incredibly disappointed if the next iPhone is so bad. But ultimately, Apple cannot force anybody to buy it. You see, that is what I'm saying. Now, the problem is that we don't live in a world where we have non-aggression. There are plenty of large companies that can definitively force clients to buy. Why? Because in fact, they leverage the force of government to get their business. So in this case, you have plenty of. France is a specialist. We have
very few countries are purely free markets. You touch on free markets in the book.
But again, so the problem is that if we go into non-free markets, we are digressing into what is the appropriate use of force to get your way and make money.
But a lot of the companies, again, just to really bring it back to concrete, a lot of the companies that we even deal with operate in heavily regulated markets. Again,
but
pharmaceutical
again,
companies.
there is very much degrees. There is degree where the regulation just say, here is things that you cannot do, but you're free to do whatever you want. I will not help you. I'm just saying what you cannot do. I would say that's our clients. So they are regulated in just the sense that there are things that are not allowed. That's it. That's it. For example, if you're a fashion retailer, the type of inks that you use for your clothes are extremely limited. You cannot use any kind of ink because some inks are very toxic. So it is heavily regulated.
Yes.
But that's it. Nobody forced. Now you have other companies. We don't have those companies as clients, but other companies where the state has say, you have a mandate. You're a private company, but I give you a mandate. And every French citizen is a mandatory client of yours. They don't have any choice. They must pay. They must pay. So you are essentially a private entity, but you have a mandate and then you collect money from citizens. And if a citizen, you say, I don't really, you're a private company, I don't really like you, I want to quit you, then the company say, you know what, I have a mandate, it's not an option. You don't have this option. So here, if you don't pay, it's police and jail for you. So you see, here it is a game played. It's not just, so we have to be aware that in regulation there are like two completely different things at play. There is the regulation that is just limit what the company can do. But ultimately, you can, as a customer, it's still completely non-aggression. You can still walk away. It just means that the company cannot do anything that you can dream up. For example, if you say, oh, I would like a company to sell me a nuclear device. And then the state say, well, hold up. No. No company will sell you a nuclear device. Sorry. But fundamentally, that limits you as a customer and that limits the company. But still, this relationship of non-aggression, it is intact. It's just that, sorry, there will not be transactions for like components of nuclear weapons happening freely on the market. So that's the limit that we have. Just like if an ink is extremely toxic, the state will not let someone sell that, even if the customer is willing to buy. So you see, that's just saying, no, you're not going to sell that, and no, you're not going to buy that. Okay. That's a very small limit. Versus, you company will sell something to this guy, and this guy can't say no, and you can't say no either. So you see, it's like forced transaction. So what I'm just saying is that the paradigm in which I operate for this introduction to supply chain is essentially a non-aggressive paradigm. I'm just describing kind of idealized supply chains where aggression is not on the table. That's it. I'm not saying that aggression doesn't exist in the world. I'm not saying that armies do not exist. I'm just saying that the playbook that is there is essentially non-aggressive. That's it. That's the only thing.
Okay. Well, again, there are a few points where because I don't want to get, look, I studied philosophy, I don't want to get lost.
Yeah, but it's important because if we want to understand why making money is not a bad thing, is that because whenever people think this company is making money in bad ways, it is invariably either because they don't understand that the only way so either the company is like a good player, either the company is literally doing what people want. So, for example, maybe the company doing Pokemons, you think that Pokemons are stupid. That's your opinion. And so you think, oh, the company doing Pokemons, Japanese company selling those Pokemons, they should be banned. But it turned out that there are millions of fans of Pokemons. And so they love Pokemons. So all those people disagree with you. So even if you think that the CEO of the company producing the Pokemons, they are doing a disservice because in your opinion, it's making people stupid. That's your opinion. In your opinion, the money earned by the CEO is unduly acquired. Your opinion. This is a categorical mistake. The CEO is just doing what people want. People want Pokemons, he gives them Pokemons. It is not for him to decide that, no, after all, Pokemons might not be a good thing for you. I'm going to stop doing that. You see, it's just what I'm saying here. It's very different from the CEO is doing money because, for example, he is using a state to ransom citizens. That's a very, that's what I'm saying is that people are systematically conflating. And so what I'm saying is that if you approach supply chain and money and economics right, which is non-aggression, then I'm saying there is no such thing as people out of voluntary cooperation making, I would say, bad money because the money is voluntarily given in my paradigm.
I don't think many people would disagree with that. In fact, because again, the thing is, but again, the book is you're not writing to the general audience. You're writing to the general supply chain practitioner audience who operate within the framework you're talking about.
But you see, yes and no, because again, the reason why I was making this point is that many of the supply chain books that I've read are failing on this test. They misunderstand this very point that we just described, and thus they end up with a very incredibly fuzzy, and usually when it comes to the goals, they end up with an incredible list of so many goals for supply chain. They end up with 20 different goals, and they would say, for example, sustainability. And for me, so let's for example, that would be an example why I do not think this is not a goal. Sustainability is not a goal. The answer is very simple. people generally don't want their environment to be destroyed. You see, so the general will of the public, there is very few people who says it probably exists, but it's like pathological, that want to see the world burn, their forest burn, their environment destroyed forever, etc. It's like 0.01% of the population. So 99% of the population want something that will be preserved. They want that their children will inherit an earth that is better than the one that they had. So how can you profitably operate anything if you have essentially something that is so important for your customers? You see, it's not possible. And if we go a real life example, IKEA started to plant trees to build their furnitures almost a century before this sort of concerns came into the table. You see, we didn't have to invent sustainability in the modern term for a company who is in the business of cutting forests to build furnitures, for this company to realize that they need to plant forest. They started to plant forest. People can confirm online. I think top of my memory, they started to plant forest like in the 40s or 50s. You know, they did that way before they became the giant they are today, where planting forest is an actual concern because they are cutting so much. But you see, that what I'm saying is that if you make the money right, because people want something that will last. You know, it's again, very few people have this sort of scorched earth thinking. Very few people with that. Making money needs to be sustainable. It's built in. And thus what I'm saying is that if you expand the list of goals into cherry picking plenty of stuff for virtue signaling, you are losing sight of what matters the most, which is making money. And that's not a good thing. That's what I'm saying.
Okay. Well, for the sake of pushing forward, I'm going to presume that most people who would pick up this book and read it would probably concede that point with you from the outset if they're operating within the same framework as you are, which is if you're working within supply chain to one degree or another, you're assenting to operate within a somewhat capitalistic framework. But I don't want to get lost on that because I actually want to focus on the actual meat of the economics argument, because the whole thesis of what I know to be Lokad's perspective and your position as you present in the book is that supply chain is a branch of applied economics. And in the book, this is chapter 4, so we're now well into the book, you start listing general laws, as you call them. General laws of economics cannot be evaded. And you give 3 core examples. Obviously, supply and demand, most people will be familiar with. Diminishing returns, most people, I think, might be familiar with that. Some people might not be. And then the Ricardian law of comparative advantage. Now, again, that's in the opening sections of this chapter. From the perspective of the supply chain practitioner, why are those 3 listed as being core concepts that you must grasp? Supply and demand goes without saying, but things like diminishing returns and the Ricardian law of comparative advantage, how does that fit into the average demand planner's day-to-day?
So, on a very, very grand scale, supply chains, not the supply chains generally. I'm describing like the cohorts of companies. Yes. So it's different thing. You know, supply chain is the science of your allocation of resource. Supply chain sprawls. It is much more like a macroeconomic perspective with a web of interdependent companies. So the question is, why do we even have this web of interdependent companies called supply chains, plural?
Yes.
You know, why is that? And the short answer is division of labor. It makes everything better when we do that.
And we make more money.
And we make more money. Exactly. That's very good. So it's something that is win-win. So everybody wins. But the question is, it is strange. It is strange. You know, you have to pause for a second. How come that in this supply chain sprawl, we have companies that seem so incredibly backward? If there is a company that is, let's say, Amazon, that is better in every dimension, every single dimension, Amazon is better than company X.
Yeah.
Why would ever Amazon rely on company X? You know, it's a very strange question. It's a very strange question. What is going on? Why should Amazon not internalize what company X is doing if Amazon is better on every dimension? And the short answer to this question is the Ricardian law of comparative advantage. It explains why even if you have a company that is worse on every dimension than another company, it can still be profitable for both to trade. And again, that is a fundamental understanding, because that's how you will understand the boundary of your company. So your company is a piece of the supply chain. It's not all the supply chain. You do not go from extracting the minerals from the earth to essentially selling selling car lease. You see, so there is a whole chain of things between I extract the metal to I am a financial operator selling not even the car but the lease of the car. So there is like a whole chain of things, and I'm just saying, to understand why those boundaries even exist and emerge, and thus to understand the limits of the game that you're playing, because you as a supply chain practitioner is operating within a single company, you need to understand this principle, the Ricardian principle. Otherwise, you will not understand why your company is not doing everything end to end.
Well, this actually sets up the concept, which I think is actually core to understanding the chapter, your overall philosophy, and I would say what Lokad does itself, which is what is the return on the allocation of your resources. So again, if you're talking about the example of Amazon and company X, Amazon can do all of these things, but the whole point is, where does it maximize the return on its time, energy, and resources?
Exactly.
Even if the other company produces an inferior version, if it's still more profitable for Amazon to outsource it to that company, that should be the choice. Okay, because you're trying to maximize what you call
your rate of
return. So that to me is like, that's the central concept. We can get into decisions as chapter 8, but how we even rank decisions is predicated upon an understanding of the concept of rate of return. So Johannes, explain to people who have not read the book, explain what that is. Actually, explain it to me as if I'm a busy ops director and I just need to know, okay, I need to know more about the financial side of my decisions.
So we say making money. Let's unpack that.
Exactly.
Making money in supply chain means you take your dollars, you convert them to atoms. So that's going to be stuff, physical stuff. You convert that to stuff.
I'm a busy ops director, Johannes.
And you do things like transport, transform, distribute, advertise. And at the end of the game, magic happened. The stuff transformed, transported, etc., is converted back into dollars.
Yes.
More dollars.
Yes. Hopefully more dollars.
More dollars.
Yes.
Thus, you had a starting point of dollars. You had like $100 initially. You convert that to stuff. You do stuff. And at the end, you transform the physical stuff into dollars back. And now you have $110.
Nice.
Money.
Yes.
Money. And okay, now we have actually increased the amount of dollars. We are making money.
Yes.
Now the idea of rate of return, we want to play that game as fast as possible. How long did it take to go from dollars, stuff, and then stuff to dollars again?
Yes.
If I can do that in 1 year, $100 in January invested, and by the end of December I have 110, I have a 10% annual return.
Yes.
If I can do that in 1 week, I have 10% per week, which will be, if I annualize that, if I compound, it's going to be enormous.
Yes.
So it's not just investing and getting more. It's about
doing
it. It's time sensitive. It's doing that in the time frame that is as short as possible.
This is where we're getting, I think, into because the philosophy is nice, but when we're getting into the concrete topics like time.
Yes.
Because again, no one will challenge you about the idea of, if I invest 100, it would be nice if I made more than that. I mean, that is the absolute basis of not only supply chain, but everyone's own time. I do things, I want to earn money for the time that I have invested. But when we talk about time, that to me, I think, is a concept that is a little fuzzy to people. And that gets into a periodic rate of return.
Yes.
So it's not just rate of return. Please expand a little bit more on why time preference is important here.
That's the key. Is that
sorry, and in the supply chain context, excuse me.
Yeah, it is. So the thing is that you see, making money is something that is fundamentally time dependent. That you cannot remove the time dimension, otherwise you don't know what you're talking about. So when people say thinking I earned $1 million, oh, great, I earned $1 million. So the question is, yes, but how much time did it take you? Because if it took you a lifetime to get there, you might not be that rich. You know, if you divide that by 40 years, it's $50,000 per year. It's nice, but you're not rich. If you say I made $1 million, but that's what I did last week, and I'm going to do that again every week, then you say, we are not in the same. We are not in the same business. So supply chain is an iterated game. It's not winning the lottery once. It's doing it over and over and over, and as fast as possible. Thus, the time dimension is fundamental. It's making money. It is literally how much money I can make as fast as possible. And that's the rate of return gives you essentially something that say, if I have this quantity of initial money, after a year, if I annualize, how much will I have?
Yes.
And what we want to say is that we want to allocate our resources, every allocation, so that we maximize this rate of return, so that when we look ahead into the future, we have, the thing that is compounding as fast as possible. This is why, again, capitalism is so incredible, is that it's trying to have this initial seed of value compound into something bigger. And that's how all the very, very large fortunes of that were, by the way, that's where I said force and not force is completely incredible, is that pre-capitalism, the only way to amass a fortune is to have an army and conquest. Yes. That's the only way.
Expansion.
It's you expansion, you grab, you
pillage,
enslave,
you plunder,
you pillage. That is the game. And by the way, so if you look at all the great, the people who are very rich in antiquity, with a few exceptions in the Roman empires, they had incredibly wealthy gladiators, for example. But again, the thing is, before that's the invention of modern capitalism that is give or take like 400 years old. Or maybe a little bit more. It is maybe 600 years more. Or before the invention of capitalism, the only way is conquest. With capitalism, you have this magic of being able to just through cooperation have these compounding effects. And the reason, by the way, why in the popular imagination it's still not very understood is that when people see those I would say CEOs, let's say Elon Musk, who end up having fortunes. They think that, damn, this guy, he must have stolen the money. But if you look at the story of Elon Musk, no, it is speed rolling. But again, we have complication because part of the clients of Elon Musk are the American government, which is, and then we are entering territory of chronic capitalism. But let's say to something that is, let's say, a cleaner example would be Ingvar Kamprad, founder of IKEA. He managed to turn that, and no, it was like free market all the way, and he just turned a small seed into a bigger one and a bigger one and a bigger one, just with those compounding rate of return.
Well, this is the thing, because I mean, I already know the answer having read, but I do want to lay down a marker here, because I think the way you have explained quite concretely, I will say, rate of return, and you've touched on time. That to me is a bright, shining line that separates what you're selling, or what, like the perspective you're presenting, and what you typically rail against, which is the mainstream perspective. Now, I want you to unpack why what you just said is absent in the mainstream perspective. Because again, you've said things, just to give you a little bit of context here, because I do want quotes.
Yes, please give me a refresher, because
no, it's fine. It's just I want to give these. We can cut out my hesitation here. Yes. Rate of return, not arbitrary, non-economic metrics such as service levels, must be optimized. And that's from page 89 of the book.
Yes.
So again, and time, the time of that rate of return is a core part of rate of return. And then we get into a periodic rate of return. But again, why is that different? Like, most people could say, well, look, I work at a multi-billion-dollar company. We're doing exactly what you're talking about, Johannes. We're maximizing the rate of our return. Why is that not what's happening?
Because that's not what is happening.
Okay. How is that not what's happening?
So there is the main issue is that people know intuitively that making money is the point of the company.
Yes.
That they agree. There are very few. By the way, it's very funny, but it was when anecdotes from my parents.
Procter & Gamble?
Yes, Procter & Gamble. It was a question that they were asking new candidates that were applying to Procter & Gamble 50 years ago. And it was part of the Procter & Gamble process to not fail applicants if they could not answer this question.
Sorry, what was the question?
The question was, what is the point of Procter &
Oh,
Gamble?
what is Procter & Gamble?
So literally, they were asking as hiring process, okay, what do you think is what we're doing here?
Yeah.
The correct answer was, expected from applicants, was making money.
Making money.
Most applicants, literally the quasi-totality of applicants who were fresh out of business school in France could not answer this question. They would go into crazy explanation that had nothing to do with the burger. So the problem is that if they had decided to fail applicants on this, they would have hired like 1% a year.
Yeah.
So it was something that was so little known, little understood by people fresh out of the very best business schools in France, that they had as a policy at Procter & Gamble decided to not fail candidates on this question because they would not hire anybody if they were failing people on that. So it was funny. So you see, when people say it's obvious, I say, oh, it was not obvious. Certainly not. It took, in fact, American companies to teach that to the French ecosystem. Because the French ecosystem, again, we are back 50 years ago, it was clueless for this sort of thing. So you see, the economic domination of the US wasn't like an accident. It was because there were a lot of people who understood earlier than other countries, including mine, that how the game should be played. And that's why those mega corporations all came from the US, or actually a very large number of them came from the US, because the US had more people who understood how the game should be played. That is good. So now people say, making money, yes. Nowadays, people would say, no problem. Yes, the goal is making money, fine. But now we have a lot of non sequitur. What do I mean? Is that people leap from, oh yes, we make money, and that's why we need to optimize service levels. I say non sequitur. How
Latin means does not follow.
It doesn't follow.
Random thing is what
it doesn't follow. It's like we need to make money, and thus I do a sacrifice to appease some gods. Again, it doesn't follow. You don't have to.
It's a bit of a. I know the point you're getting at, but like I have to jump in there. Sorry, that is.
It just do not follow. Do not follow.
Okay. So I have to suppress the fact that I work at Lokad, and I have to push back and pretend. Joannes, if you say to me, service levels, which essentially represent the promise I make to my customers, whose money I want, if you're telling me that service levels, maintaining a high level of service, does not represent an economic metric of some kind.
Absolutely
That's
not.
hard for. Okay, unpack why that is. Don't just say that it is. Unpack why that is.
Service level is a percentage.
Yes.
It's a percentage.
So it's profit.
No. It's a percentage. It is just a percentage of availability for a given SKU.
But if it's zero, you don't make money.
Or do you? Or do you? Again. Let's take, for example, a simple example to challenge this assumption. Okay. What you just told me.
Okay.
Apple. What is the service level of Apple right now guaranteed for the iPhone 6?
The iPhone 6?
Yes. What is the service level that currently Apple guarantees for the iPhone 6?
I'm going to guess zero. I'm going
to
guess
zero.
It's like
zero.
What? Is that 15 years ago? I have no idea. I have no idea. I'm going to guess 15 years ago.
It is completely obsolete. It's ancient history.
But that's not Apple's promise to its current market base.
So what Apple promise is not a service level. We have just demonstrated that. So the iPhone 6 is at zero.
Yes.
So what Apple promise is a quality of service.
Okay.
What they promised and what people expect is that if you buy this iPhone products, whatever it is, it's going to be the very best one that has ever existed. You see, so the promise is, if you walk into a store of Apple, the iPhone that you will get, if you're willing to pay, will be the very best phone. That's the promise that they're saying, the very best phone that has ever been made on Earth.
Yeah.
Obviously at scale. But you see, so this is a promise that they're doing. It has nothing to do with this percentage availability that we just discussed. You see, clients, their expectation, the quality of service is something that is much deeper than a percentage.
Okay.
It's, for example, if Apple tell you, dear customer, today I'm not going to sell you what is here. Really, I think that's not exactly what you want.
Yeah.
Why? Because tomorrow I'm receiving the next generation.
Yeah.
I'm very sorry. This one, until today, it was the best one, but tomorrow we have the better one. So maybe, dear client, are you okay to just wait one more day so that we can fulfill the promise of you having the best phone ever produced? You see, and obviously people would say, oh yes, absolutely, that's what I want. Yes, it's an expensive, it's like more than €1,000. Yes, I can wait one more day if you tell me that tomorrow, and maybe a billionaire entering the room say, no, give me one today and I will buy a second one tomorrow. I don't care. But you see, that's not going to be your average customer reaction for the vast majority. So that's why I say service level is just a very bad proxy. It's a proxy, but the quality of this proxy is so bad that almost invariably you should not use it.
I think, again, I like the example. I think you gave it in a previous episode, in fact, was of, let's say, a fashion company. Do you maintain 96% service level right at the end of summer when you're about to phase out your lines and launch your winter coat collections?
Yes.
Probably not, because that would be kind of mental.
Yes.
Like the day, I don't know, September 30th, are you still going to have 99 or 98% service level for your swimsuit? If you do, you're probably going to lose a lot of money the next day when October hits, etc.
And let me get another example where we enter into even stranger territories. What would you think of a merchant that says, I'm going to sell you this thing, but I can take it away at any point of time in the future and you will thank me for that? It sounds strange. So I'm selling you something, but you know what? Part of the contract, I can take it away from you. And you will agree to that. And you will be even thankful that I had that.
Like a software vendor or something you're talking about?
No, aircraft parts for retrofits.
That's correct.
So
yes.
Aircraft parts, essentially, when you are an OEM, security is paramount. You do not want to kill people. I repeat, you do not want to kill people.
It's the go-to example.
It is. The rule of the game is people need to arrive alive.
Yes.
That is anything else.
Even if it's not on time, alive is what we aim for.
Yeah, exactly. As they say in aviation, it's the early aviation. A good landing is a landing where everybody in the planes can walk away from the plane unhurt.
Yes.
And I would say an awesome landing is when the plane can even, fly back afterwards.
Yes.
But a great landing is everybody can walk in one piece away from the plane after landing. So this is a rule of the game. And in terms of money machine, if we don't respect this environment, the money machine stop. Because if you kill someone, the machine just stop. You see, it is, you don't need a regulation. It will just stop. And that is critical. So what am I talking about? If I sell you a part and then I realize afterward, oh crap, there might be a problem with the part. I'm not even sure because those people are like completely paranoid. So if they have even a suspicion that the part might be compromised, that it might endanger people, they are going to do a retrofit. So they are going to say, every single person that ever got one part from me, you've got 1 week to send me the part back. You must. This is important. Will you sign a contract with me saying that you would? So now you send me the part. And you know what? Meanwhile, I send you the new parts. Every part that I ever send, here is a new part. And yes, we have both agreed initially that doing things like that would be ideal. So you would have a new part. So you have the replacement. Your aircraft will keep flying with a new part that is safer. But me, I don't want my reputation to be damaged by the fact that maybe there is a little probability of something went wrong. And the retrofit, the game is, if you don't give me every single part, I want every single part ever produced, accounted for. So that, and I would say, if it's not the case, and the plane crash, it will be on you. So not the OEM doing the part, but whoever failed to return the part, it will be on you because you had the good parts. So that's, it can get strange, but this is why, again, try to understand service level from this perspective. You see, it's mental. It is such a bad proxy. It is not even remotely close to approximate the game being played, which is making money by never killing anybody in the process. That's the aviation. You want to transport people in an incredible safe way.
It's certainly an imperfect proxy. I don't think anyone would dispute it's an imperfect proxy.
Yes.
Based on we could list examples all day.
Yes,
What I want to
exactly.
push for, because I think we've given three. I think
Yes.
we've circled the pond on that one. What I want to push forward on is a key part of the rate of return argument, and it actually touches on the idea of time again, and it touches on the idea of time, and it touches on your criticism of the mainstream, but in a concrete way, the mainstream supply chain theory. You make the point that the idea of like trying to make your decisions or even measure rate of return with time horizons like week, month, quarter, year is arbitrary, and it lacks a certain amount of precision and granularity. You capture this idea and you describe it using the term a periodic rate of return. That's fancy, but break down what the idea is and why a much more granular understanding of time influences the money that you make.
So the thing is that rate of return as a concept used in finance is it's fundamentally an aggregated concept. It's a macro concept. So it just say, imagine you are a finance guy and you just want to look at the rate of returns of your investments over a long period of time. And so this annualized investment kind of makes sense because you are comparing apple to apple. You are comparing, if I invest on this company, what is the projected rate of return? If I invest on this company, what is the projected rate of return? Apple to apple. And I can normalize everything looking at yearly returns. And typical, just for the audience, the rate of return that you can expect from, let's say, the market, stock market, it's about something like 7% a year.
S&op, if you're investing in S&op,
and by the way,
pretty standard.
7% mean risk. So if you say, I want rate of return with zero risk, so I will never lose any money, what you can expect is probably about 2%.
If you're lucky in
if
France,
you're lucky.
2%.
If you say, I am willing to have bad years, so years where I lose half of what I have, but I can play the long game, let's say 20, 30 years, then 7% is what you can expect. If you are really pro-risk and you say, you know what, I'm okay to get my money not to half but to zero, then you can get 20%. But then you have a very severe risk of actually getting to zero. That's like the risk taker sort of perspective. Okay, back to the initial point. In the finance world, because companies, it's a human thing, it is kind of slow. Even if you look at giants like Apple, it took decades for them to become giants. So it takes time. Even, the fastest company, Google was one of the fastest growing company ever. It still took them almost a decade to actually enter the stock market. So we are talking of slow moving objects. Even when we say this is the fastest company ever, it is relatively slow moving. It's a process that takes years. Thus, the annual rate of return is all that you need when you're thinking like that.
Let's get to demand planners and supply chain people,
but
please.
Supply chain, the problem is that you are making decisions, so you are spending and earning money every minute.
There we go.
So, and the problem, and you have a second problem, is that, so first you're spending and earning money every minute.
Yes.
So averaging everything at the end of the year is nice, but it's not operational. It's just a way that tell you after everything that you've done if you did it right or not.
Yeah.
But operationally, it's not granular enough. And then you have another problem, which is you are doing spendings and you're getting earnings, but those things, they are not connected. So how do you connect so that you can see what the connection between what you earn and what you spend? And the problem is that it's very opaque. It's very opaque because your company is big actually. And so you have all this problem of, first you need to have something that you can operate more, I would say, at a much lower granularity, so more fine-grained granularity.
Yeah.
That's the thing of the aperiodic rate of return. That's just a formula I give. It's in the annex, by the way.
Yeah, it's in the annex.
And then you have another problem, which is how do you attribute the the value that is being created. And here we have a whole segment on essentially value attribution that is also discussed in this chapter, so that we can connect those things, what you spend and what you earn. And this value attribution is a very thorny problem, but it's fundamental, because otherwise you can be fooled because you may be under the impression that what you're doing is right, while in fact you're just wasting money left and right, and you cannot assess the counterfactual. So the counterfactual is, you can only know if what you're doing is right if there is not an alternative way to do it much better. So even if you're making tons of profits, maybe there is a counterfactual that would say what you're doing is wrong, because if you had done it differently, you would have done even more profits. You see? So right or wrong is not an absolute for your rate of return, is to make sure at the end of the day that no money is left on the table, that your rate of return is as good as you can ever make it. That is fundamentally what we're discussing here. So again, two problems: aperiodic for granularity, and attribution problem, so that we can connect the inputs with the outputs.
Okay. Well, so there's a section, because this we'll come to the idea of like visualization here, but like the description that you give operationally, and you use the term operationally. This is page 91. This is not a criticism. I'm literally going to ask you to explain this, just in case you're like, where's this going? I just want you to, I'm going to read it, and then I want you to concretely link it to a supply chain situation. Like, if you were the aerospace, the MRO company we described earlier, or an FMCG, or a fast fashion company. So operationally, the aperiodic rate on return slides a cursor along an option or decision's cash flow timeline, computing at each date the rate that would prevail if the decision were closed out then. It keeps the maximum value. The date that yields this peak becomes the option's implicit horizon. In one number, the metric captures both the scale of the gain and the fastest pace at which the tied-up capital can compound. And as you said, the exact rule is spelled out in the annex. Okay. Explain what that looks like, because it's a core concept. What does that look like to a demand planner on day one if they go, that's brilliant, I love that? What does it look like? What happens? What's different?
So let's imagine a very simple situation.
Please.
You are a retailer like Walmart.
Yes.
And you have an opportunity buy to get something that would be interesting. You get an opportunity buy for a very durable good. Yes. So that would be, for example, let me say, spoons. So you have an opportunity. It's a one-time opportunity. And I don't know, a Chinese supplier went bankrupt. Yeah. And now you can buy such a huge amount of stock of spoons, metal spoons, at an incredibly discounted rate. Yes. Okay. So you would say, oh, it's nice. I can buy, I can buy the equivalent of 5 years worth of spoons at a 98% discount. I'm obviously making the example extreme.
It's just for the sake of discussion.
So it's an opportunity. I take it. I'm not short on cash. Yep. I will be able to sell those spoons with crazy margins. Not only I will be able to sell the spoons at a much lower price than my competitors, but I will make a lot more money in the process. So I do exactly that. And I have this stock of spoon that is crazy high. Yeah. Now, I know that the problem is that my clientele, even if I'm Walmart, doesn't have the capacity to absorb all those spoons.
Not in the short term, no.
Not in the short term. It's just so much. And I have another problem, is that I anticipate that those spoons will slowly get out of fashion. Okay. So year one, I will maybe liquidate half of those spoons. Year two, I will liquidate a quarter. So I will be at 3/4. Year three, again. But, and again, why am I selling less and less? The answer is because the fashion will have evolved, and this is not exactly the type of spoon that people want. It's sufficiently, stable so that it will not crash down. But if I think 10 years from now, I can say, the taste of the market will have changed. It's a subtle things, but the demand, no matter the price for those spoons, will be about zero. Okay. Which means that I will start to earn money maybe in year one, I already make a nice profit.
Mm.
Year 2, I also make an even bigger profit because, I will keep selling those things. But the total profit is so far into the future. It is like super, super far into the future. It's like mind-blowingly far into the future. I will maybe, if I were to really try to sell them to the last spoon,
Yes.
it might actually take 20 years.
Okay.
Should I compute my rate of return
Okay.
taking all the money over a course of 20 years?
Mm.
It doesn't make sense.
Okay.
You see, I don't need to compute my rate of return to wait until I have sold every single spoon till the last.
Mm.
Why? Because maybe after just 1 year, I have made big profit, big rate of return. So I have a rate of return that is very positive. Maybe after 1 year, I will have, let's say, compared to my initial investment, a 300% rate of return because it's such an opportunity after 1 year. But if I let, the second year, it's twice as long in terms of time. And obviously, I'm only selling like half of it. So
and you're also occupying shelf space that could
exactly.
be with something else that is
so
at a higher profit.
Diminishing, exactly.
Yeah, exactly.
So my projected rate of return for year 1 might be 300%. My projected rate of return for year 2 might only be 150%. My projected rate of return for year 5, for example, might only be 105%. If I look at 20 years ahead, maybe my projected, for the sake of this illustration, 20 years, is my projected rate of return is just like 1.01. So you have like a 1% annualized rate of return. That's a 20 years ultimate perspective. But then hold on. If you say, because you need to run this game till the end, and now you're at 1% of annual rate of return, and you say, this is not an opportunity at all. 1% a year, it's worth nothing. Hold on. You're forgetting that year 1, you had a 300% of return. So obviously, if you just compute naively this rate of return until the end of time, you end up with a number that is very, very low. But this is a stupid number because you could just pause your analysis at year 1 and say at year 1, I just look at how much money I've made and now I just throw the spoons away. I just donate them to, let's say, a metal foundry. I don't care.
Yeah.
I just donate them to whoever industrial is willing to get the metal for free. And then I cut the time horizon, it's an arbitrary. I cut the time horizon and that gives me a much higher rate of return. This is obviously the correct way to think about the rate of return. I cannot say at a point in time I had such a good rate of return, but then later it diminished. No. Because if at some point in time I get like my peak rate of return, I should just say I pause my analysis there. If at this point in time there is nothing to be done with what is left, I should just sunken cost. I should just throw it away or donate to whoever is willing to get it for 0. You see, I need to have the rate of return. So that's the aperiodic rate of return. It's just a heuristic to say you look at the entire timeline and you pick the point in time where your rate of return is the highest. And this is what you mean when you have a game where essentially earnings never stop. Because the reality in supply chain, the way it works is that earnings and spendings, in fact, never really stops because the spending due to storage space, they will continue indefinitely as long as you have one unit that is laying, on the shelf.
Yeah, exactly.
And
there's opportunity cost to that as well.
And the earning can still drop in very, very slowly. So the problem is that you have this tail.
A very long tail.
That is very long, but also very insignificant.
Yes.
It's very insignificant.
Okay. And how is this different then from how you've given that example? How would the service level perspective or the safety stock perspective fit into that example? It would be different. How?
But the safety stock and the service level
the non-economic metrics.
They are not economic, and more profoundly here, they are non-temporal.
Okay.
So you see, time do not even exist in the perspective. It is perceived from the truth is that they do perceive time, but in a very strange way. That it's not what people really think.
Okay.
They are embracing a stationary perspective. So stationary is a way, the stationary perspective is say, I am playing a game that has no beginning and no end. So time, I'm just repeating myself on a loop endlessly, and this loop is stationary. This is just like a sinusoid.
Yes.
You know, this curve that oscillates from the beginning of time to the end of time. And so, service level and safety stocks, they embrace a stationary perspective, which is it's an extremely strange perception of time.
But pragmatically, from the example that you just gave, the aperiodic rate of return would tell you basically after year one, you can pretty much cut your losses here. You've more or less maxed out your realistic return.
You don't need to answer this question yet. You see, because maybe 1 year from now, you will realize that those spoons are fashionable again, and your assumption about the future was actually fairly incorrect.
Okay. So it can change. Agreed.
It can change. So the aperiodic,
but the opposite is
the aperiodic just tell you, is this investment in front of me?
Yes.
Based on the information that I have,
yes.
Is it a good investment?
Yes.
That's it. It just tell you at a very granular level,
yes.
Should I make this allocation of resource or not?
Yes, agreed.
That's it.
And what I'm saying is to contrast this perspective with the other non-economic metrics that you criticize.
Yes.
How would that differ? So you are the exact same,
level.
Walmart, I have 1 million spoons, but now I've got service levels.
Service level will tell you, you need to enforce this commitment, this percentage. And thus, to enforce this percentage, you need to allocate resource. It never asks the question of whether your resources are being allocated in a profitable way or not. It just says you must. You see, a service level says you must allocate resource. That's you. If you say this shelf 99% service level, it says you must allocate. And what if you are losing money like crazy? Just to give you an example, if I say strawberries 99% service level, at the end of every day for a grocery store, I will be throwing away tons of strawberries. The service level do not care. It will just tell you
by vertical.
It will just say put the strawberry on the shelf. This is your commitment. I don't care about profitability. Just do it. So you see, the service level forces you to allocate, even if there is no profitability. And conversely, it does not tell you to over-invest when in fact it is very profitable. So for example, back to our spoon opportunity. If Walmart is thinking, okay, what is my service levels for spoons? I say, why should I buy this enormous bulk amount of spoons at such an incredibly discounted price? I don't care. My service levels are already met.
Yes.
I don't need to seize this opportunity. It is irrelevant. So you see, it's both ways. The service level...
That's a clearer point.
Yes, the service level forces you to invest when it's stupid to invest. But conversely, even when you have like an extravagantly good opportunity where it's like, oh, how can I miss this opportunity? It just say, I pass. This is dumb. This is so dumb. And that's why I say it is a proxy, but it's so mediocre. So mediocre. It's... it is the sort of proxies that would say, it's great artists have a name that starts with the letter L, just because Leonardo da Vinci and Karl Lagerfeld exist. So maybe the letter L happens to be a proxy to find some great artist, but when you think of it, it is a very, very, very crappy proxy. You see, so that's the problem, is that it's very easy to invent proxies that looks good on a toy example. You know, the L for, you know, the last name starts with an L. It's going to be a great artist. Example, Leonardo and Karl Lagerfeld. But then you realize, but shouldn't it be V, because Da Vinci? Again, you see that, so you see, it's fundamentally, I would say, service level is a very bad proxy that academia managed to make they succeed in demonstrating the value of this proxy in cherry picking crazy examples, using crazy thinking such as stationary perspective, and thus it is kind of semi-convincing to people. But the reality is that real life supply chain practitioners, they don't even do that. They will seize the opportunities when they see them, because they are not idiots.
Okay. Well, I'm going to push forward from this point, because I think we've dug down as far as we're going to right now, and I do want to touch on at least one more point before we draw to a close, and it's actually related to the points that you just made, or an extension, because again, you you decry, perhaps with warranted, you decry the idea of what you call non-economic metrics, and you say
Yes.
they don't necessarily they're let's say imperfect proxies. I'm going to say
Yes.
imperfect proxies
Yes.
for profitability. Fine. Thing is, you do also introduce some other heuristics, which some might argue are hazy or difficult to nail down, and you call them shadow valuations.
Yes.
And you argue that this does warrant some context.
Yes.
So, just for anyone who doesn't know, you make the argument in the book that some effects, and I would say shrewdly, you make this point, some effects don't show up in the ledger. That's how
Yes,
you put it.
exactly.
So again, goodwill with your clients. Where does that show up? Supplier distrust, consumer fatigue. A
Yes.
classic example you gave before is like conditioning clients to expect discounts. Where does that show up? So you make the point that practitioners must, quote, introduce shadow valuations. Now you do issue a disclaimer. These figures are assumptions because there is no historical baseline. So
Yes.
that's pages 125 to 126. So before we get into some of the potential criticisms or how it works in practicality, expand on this concept, how it works and why it's important.
It's critically important. Making money is good because in the real life, unlike what Hollywood depicts in their movies, CEOs don't behave like the CEO of the Hollywood movie. So
Okay.
so let's start with that because this is so.
We've covered that, so let's not spend too much
Yes,
time
but
on this.
it is important. What Hollywood depicts is ultimately people who are incredibly short-term thinkers.
Yes.
You know, they will make money very quickly using the worst thing possible.
The
They behave.
Gordon Gekko behavior.
Yes, they behave like gangsters. They will just burn everything, etc. The reality is that good CEOs, Steve Jobs and whatnot, they were looking far into the future, so far that all your measurements becomes irrelevant. You see, because if you are, the future will become what you make of it. And if you are ambitious enough and smart enough and visionary enough, you can see things where you don't have any measurement. Just imagine, there is not a single phone on the market nowadays that is not kind of a copy of the iPhone, the original iPhone. Steve Jobs knew that. He when he thought of the iPhone, he thought the thing, he thought kind of the end game. And he was right on so many things. The only things that I would say he was not completely right is that he thought that making it relatively small, and it was already a big phone, he was saying it's ideal because it's the size of the thumb. Turned out that people want to consume media. And so, in fact, what has won was the iPhone, but bigger. So, you see, I would say Steve Jobs on the iPhone, he was like 99% correct. And there is a few technicalities such as the ideal size of the phone where he was wrong. So now, this
Shadow
is a key,
valuations.
Yes, but this is key. Where this, you see, we have an information that is critical. Where does this very critical information enter your model? So you have an insight that is so important. It's not going to show up in the ledger because Apple has not even started to sell the first iPhone yet. Is it unimportant? No, it is critically important. It is critically important. Thus, what I'm saying is that there are numbers in dollars that cannot show up in your ledger. And they are critically important because they represent the future. And the shadow valuation is a mental trick, if you want, to have those human insights about the future be embedded into your economic calculation. You have essentially the stuff that is the problem is that, you see, if you remove shadow valuation, what you have is just like driving a car looking only in the rear view mirror. Your transactions, they are your rear view mirror. And they tell you what is in the past, but you need to look forward. And then you would say forecasting, but no, because again, statistical forecasting is just again extrapolating your statistical data. So the problem is that statistical forecasting is incredible, but it's just a fancy way to look in your rear view mirror. It's better, but it's still the rear view mirror. So how do you start to look at the road ahead? The answer is shadow valuations.
And examples. So let's say, okay, now I am going to tip my hand a bit. So for example, stockout penalty, would that qualify as a shadow valuation in your opinion?
It is part of it. The problem is that where it is not exactly, again, this is a spectrum.
Yes.
But the problem with stockouts is that stockouts are happening all the time.
Yes.
So the question will be, if you are in a business where stockouts happens all the time,
Yeah.
it is essentially the stockout penalty is something where you can look in the rearview mirror and you're good. Now, let's consider a business where stockout is not every day, where in fact it should never happen. You are an electricity provider. What is a stockout? It's a blackout.
Yeah.
It's a blackout. So no more electricity. So the question is, can you think? And it's very interesting because I was in New York in the blackout of I think 2006. I was in the city at the moment. It had not happened. The last time it had happened was like 30 years ago. So it does blackout in New York do happen like every 30 years or so. How relevant is your historical data to support your analysis of the upcoming blackout? It is such in the past, kind of, but frankly, it is a bad historical data. First, because it's super far in the past, and just because New York itself has evolved, transformed. So what I'm saying is that if we took something like a stockout, if you are in a business that face stockouts all day long, you can use your review mirror. So stockout will not be a shadow valuation. If you are providing electricity, and this is something that should never happen, this is a shadow valuation. You see, it depends. It depends.
Well, then, could you give an example that relates to the 10 million people who might read this book? Because most of them will not be working for energy providers.
Yes. So shadow valuation would be, for example, how the client attrition that you are going to have. So any stockout will be a small thing, and the question becomes, how, when those stockouts accumulate, how fast do you lose your clients? And this is a very nuanced question, and that's where sometimes you have to do experimental thoughts, because the actual experiment will be way too expensive. Just to give you an example, let's go back to Walmart. It's something that is very well known. For every parent knows it.
I know the example you're going to give. It's one I was about to challenge you with.
Exactly. I
know the pain.
You're
yes.
in this period. So diapers.
Yes.
Diapers. So as parents, young parents, if you don't have diapers, you are in I would say deep problems. So you want diapers, but you don't want any diapers. You want the brand that you like, that your baby like, because when you change diapers,
it's a pain.
It's a pain. It's a really pain. Thus, you are kind of very, very demanding on that. Now, because it is common sense, because it is common sense, are retailers willing to experiment with stockouts on diapers? No, they're not. They're not. So diapers are always super nicely stocked precisely because of that. So we have almost no data on stockout of diapers because retailers who knows that it's so critical, they never let themselves run out. And when I say never, it's like
very rarely.
So rarely. I suspect Walmart has probably above 99.9% service level on diapers. So it never happens. Thus, the question becomes the counterfactual, which is if you see then the shadow valuation.
That's where I was going with the original question.
We never observed, almost never observed stockout on diapers.
Because they've added value to it.
But it is a thought experiment because we know that stockout on diapers will cascade into losing parents and this and that and that.
Well, not only that, it's losing parents, but it's also losing the other things that would have been bought alongside. Because like I don't just... As a young parent, I don't just buy the diapers. It's like I also buy the formula and I want to buy groceries. It's like I'm not going to multiple stores. So I go in, the first thing I look for is diapers. If there are none, I go to the next available store.
Yes.
So this is why I gave the example of stockouts and stockout penalty, because I know, and again, anyone who's read the book can intuit that then and apply it, that there are certain things like the loss. Again, to take that example, I walk into the store, I want to buy Pampers size 1. They don't have it. We're not sponsored by Pampers, by the way. But just to give an example, that brand's not there. Okay, all the other things I was going to buy, I'm not buying. from the perspective, if you just look in isolation, oh, well, Intermarché or whatever store you want, just lost the sale on that diaper. No, they didn't. They lost the sale of the diaper. They lost a sale on the formula. They lost a sale on the milk I was going to buy, the eggs, the cheese, the bread, the ham. They lost everything. So if you look at and this is now where mainstream and what you espouse really, again, come into sharp focus. If you say, well, it's the losses are limited to one thing, you're missing the cascading effect that you just said. And that's where I think shadow valuation is important. And you gave the own example. You were kind of disagreeing with me, but you were giving the example that I was literally thinking of, which is there are certain products where if you have a stock out, your losses are not just limited to that thing. It is everything that would have been bought in combination, or I think it's the basket perspective you use.
And as a young parent, if you go twice in a row to a store and twice,
I'm not going back.
Then you're not ever coming back.
Yeah, exactly.
So it's not just the basket; is that then you have the lost, the customer forever, and again, retailers are smart. People at Walmart, they are smart, so they know that. So they don't play the game. Thus, they never have any data, almost. Because by definition, this is a game they don't want to play.
Yes.
But because they need to have an economic reasoning, because at the end of the game, at the end of the day, you still need to decide how many diapers you have in stock. So ultimately, you still need to kind of make an investment, even if you know that your measurements, historical measurements, will not be an accurate measurement.
But the justification is the shadow valuation.
It is a way to rationalize. Yeah. And then the interesting thing, why do you need those shadow valuation? Because in fact, you are going to have many shadow valuations.
There we
go. And now it's going to be okay. We need we need to have that. But guess what? For example, Walmart, I think now in the US, again, I don't live in the US. I believe they are selling insulin too.
I don't know. You can get
so
probably.
Insulin is critically important, and that's going to be the same thing. Now, so that means that my shadow valuation for diapers, which is critically important, is going to compete with my shadow valuation for insulin.
Because you're allocating resources one way or the other. Exactly.
And again, and now I have a game where I will be able to, as an experiment of thoughts, just balance those things so that I am consistent. And again, the problem, and that's where we are back to economics, scarce resources. At the end of the day, even a company that is as fantastically rich and powerful as Walmart has only a finite amount of resources. Thus, those resources need to be wisely spent. And that's
rate of return comes.
That's the rate of return. And the shadow valuation is just to make sure that you're playing the long game so that you can make a lot of money because you're looking far into the future.
There's another, again, it's just merely another anecdote to demonstrate the point, because again, you one of the other examples, I don't recall it being listed explicitly in the book, but again, it's I work at Lokad, so yeah. But it's one I like, because we are actually talking about it, but you gave the example again of discounts, and discounts can instill a negative or financially injurious behavior, counterintuitively, financially injurious behavior in clients, and in fact, in customers, excuse me. And anecdotally, I have seen that a couple of times, and I know people who, for example, really like certain coffee brands at what's it called? Not Franprix, Monoprix. It's a big chain, basically the French Walmart, but not as big, but as common. Anyway, there's a certain brand of coffee, and he only buys it when it's on discount.
Yes.
So literally, he's like, when it's on discount, I will buy everything I see.
Yes.
When it's 50% off. But when it's full price, I buy anything other than it, because it's not worth it at €8, but it's worth it for €4.
And here you're behaving exactly like the fictitious buyer I was discussing with the Chinese spoon. You say it's an opportunity.
Yeah.
I seize the opportunity. Even if my service level. So if you were thinking for yourself as service level, this is dumb, because in fact you're going to be at 100% service level for a month. You go every week to the store, and you're buying coffee for 3 months. How does that make any sense from a service level perspective? You are, by definition, at 100% for a month. Because for example, you're buying so much coffee that it would probably injure yourself and your kidneys if you were to drink all that coffee in 1 week. So it's not humanly possible. Thus, you are at 100% for way beyond your lead time. What you're doing is something that is unthinkable from the service level perspective. But as soon as you embrace an economic perspective,
Yes.
it makes perfect sense. You have an opportunity, you seize it. And as long as your shelves, because then the problem becomes for you in your kitchen,
Yeah.
am I going to take 6 months worth of coffee
Mm.
and that's going to take all my shelves
Yeah,
because you're in Paris, apartments are
Yeah, yeah.
expensive and whatnot. So probably what drives your limits is first, I'm not going to walk back home with 20 kilograms of coffee.
Yeah,
That's
yeah.
probably constraint number
Yeah, that's
one.
constraint.
And then the second constraint is I'm my wife is going to be mad if there is like if I take like 3 shelves, entire shelves out of coffee bags. So that are your limiting factors, but they have nothing to do with the service level. And that's again, we go back to service level is such a terrible proxy.
Well, we've been going for quite a while,
Yes.
so I am going to draw things to a bit of a close now. But I will point out that we're now, I think it's 130, 140 pages into the book, 4 chapters. A lot's been covered. We've spoken now for well over 4, probably 5 hours. Where do we sit in this playbook now? Where, like, for people who've made it this far, what do they have to go forward with now? Like, if people, sorry, the phrasing is, if people stopped reading now, what do they have?
They have an understanding of how they can actually start trying to make their company earn more money. You know, we have now started. We have now, you know, yes, we have
We've
already
arrived.
Yes, now we don't just understand what supply chain is. We understand how it connects to making money. And thus I would say if we stop and there is nothing else in the book, people can start reinventing the rest on their own and they are properly equipped to actually reach the point of profitability. Because now I would say the game is on, you play with that, and you're going to invent stuff that will make money. So you see, we have already reached a point where now, if you understand truly those 4 chapters and you invent a new supply chain technique, first, you are inventing something that belonged to supply chain. That was chapter 3. But now you will invent something that you will be able to assess if it's a net positive contribution value-wise to your company. So you see, it's important. In the previous chapter, we just clarified, are you even inventing something that belongs or not to supply chain? Here we are saying now, are you inventing something where you have a criteria to say, am I on the right track? And here you have the criteria to say if what you've invented is on the right track. That's making money. That's what we have. So, but then I will the rest of the book will actually start getting into the nitty-gritty details of what is there to be invented to do that. But here, you are prepared now to, if you're willing, if the audience wants to do that, they are prepared to actually reinvent the rest of the supply chain, but they will be reinventing the right stuff.
So greed is good.
Greed is good.
Okay, good.
Greed without coercion. That's the thing. Is that, but it is such a nuance. And by the way, it took almost a millennium and a half for Christianity to kind of get that, because you see, it is no.
I said it as a joke.
No, it's important. You have to think that usury, because rate of return is very deeply related to usury. Usury was considered as a sin by the Catholic Church. I'm personally I'm Catholic, right? So you see, I know the history of my own religion. It was considered as a sin, but guess what? So what is the country who is the heart of Catholicism? The answer is Italy. Italy only emerged as the 19th century. So I'm talking of the geographical region, not the political entity that only arose very late.
Napoleon designed the flag. Did you know that?
Yes. Yeah. I mean so the thing is, accounting was actually, I think, invented. Double entry accounting was only invented, I think, it's like the 14th century, by an Italian monk. So it took, so you see, that's the grand paradox, is that usury, rate of return, was seen as a sin, but who invent the tools to actually maximize rate of return? That's the double entry accounting. That is this is the incredible invention. With double entry accounting, we have the elements to start playing the game of capitalism right. Without double entry accounting, nobody knows how to even count the score. You don't know if you're losing or earning money. So this is why I say it is such a landmark, this invention of double entry accounting, because it is a start where you can play the the capitalism game, and you know the score because you have this mechanism. It's so fundamental. And guess what? The very first banks are going to emerge in Italy, and the very first people who are going to play this non-aggressive sort of new rules of making. That's the thing, is that the beauty of it is that it's about creating almost value out of thin air. That's why, by the way, there was a quote from, I think, Einstein was saying, I'm baffled by the fact that compounding interest might actually be the greatest force of the universe. It was just the sort of bafflement of contemplating that it seems to be creating to a physician where, nothing is created, everything is transformed. That is the motto of physics. It seems to a physician that when you look at those compounding interests, that you're creating stuff out of nothing. And it's a little bit like that. And that's the beauty of it. But it is so strange that even nowadays, and that's what I'm describing in this book, the mainstream perspective do not see this game. They do not understand this game, creating value out of nothing. They see the mainstream theory, if I as a concluding thoughts, the way they see that, they do not see the supply chain game as a forever compounding game. They see it as cost minimization. You have a goal, that's your service level target, that's your commitment, that's your whatever. So you have your top level constraints that are laid, and then you minimize the cost to get there. That is the mainstream supply chain perspective. It's a cost minimization perspective. It is not a rate of return maximization perspective.
All right. I'm sorry I quoted Wall Street right at the end because it seemed to set you off.
Yes.
But again, a nice concluding thought. Johannes, we've been talking for quite a while now. I don't have any other questions. Thank you very much for joining me in the lodge, and I look forward to discussing Chapter 5. And to everyone else, thank you for watching. If you want to continue the conversation, you can always reach out to Johannes and me on LinkedIn or send us an email at contact@lokad.com. And with that, we'll see you for the next episode on Chapter 5. And get back to work.